Hello, this is Eric Boyce, CEO and Chief Investment Officer for Boyce & Associates Wealth Consulting, and welcome to Charts and Chat for March 9th of 2025. Got a lot of charts to get through. Let's start with this one from the Atlanta Fed. This is the GDP Now economic growth forecast, and it does a very good job, and it has done a very good job over quite a long period of time of predicting economic growth. In fact, it's probably one of the best predictors of economic growth. And you can see here over time, these estimates of U.S. growth have been, fairly consistent with some outsized numbers here and there. But this particular index has taken a decided turn for the worse. In fact, whereas for, the bulk of 2024, we were looking at something in the 2 to 3% range. We are now looking at something closer to negative 2% for the first quarter of 2025 on an annualized basis. And this is born out of a lot of the uncertainty that's out there right now, whether it's tariffs, whether it's inflation. You've got people that are being a little bit more cautious from a business standpoint, also from a personal standpoint. We had retail sales and personal consumption numbers that were softer than expected, and that all filters into this model. And so this model is now telling us that they expect negative growth in the first quarter. And if that is the case, then that puts us 1 quarter away from what would loosely be held out as being a recession. If you get 2 negative growth quarters in a row, that is usually held, as a loose proxy for a recession. So, it's been quite a while since we talked about recession. We didn't get one in 22 or 23 like we thought we might have. And you still have a lot of pundits out there and a lot of investment banks that are still, categorizing a recession as probability as being very low. But there are some people like BCA Research that feel like, it's a 50-50 proposition at this point, just based on tariffs and a lot of what that does to the psyche out there in the business world. So we'll start off with this, not necessarily the most fun thing to start off with, and I'm not spinning doom and gloom here. I'm just saying that, the first 100 days, not even, of the Trump administration has caused a lot of anxiety and a pretty fair amount of uncertainty along with it. Here we have beige book mentions of trade and tariffs, so on and so forth. You can see, how that has skyrocketed in a very short period of time, where we weren't really even talking about trades or tariffs last year, even though we certainly had them. Now, of course, we haven't seen the bulk of these announced tariffs really impact the economy just yet, but at least people are talking about it. And just to kind of bring us back home here, beige book is the Federal Reserve's summary of regional banking conditions or regional economic conditions as reported by the 12 Federal Reserve banks. And so this is a compilation of that. And just to kind of put a bow on this, obviously a lot of people are talking about tariffs, they're talking about trade wars, they're talking about potential short-term inflation leading to longer-term declines in overall growth, so on and so forth. And dovetailing that with the last slide that you saw with the GDP Now number now being negative, it just goes to show you how powerful these impulses are and these anxieties are that exist out in the economy. Here we have a couple of charts here on commodity prices and kind of digging into a little bit about some of the impacts here that we see from these potential trade war. You can see here this is the 1-day Chicago Board of Trade futures for corn. You can see that they've dropped rather precipitously. And then over on this chart from Department of Agriculture, we have basically millions of tons of unshipped crops, in particular corn. And this corn happens to be going to Mexico. And so if you're putting a lot of tariffs on this, it's going to be obviously be a problem for volume. And I think that's what you're seeing here manifesting in price. And so a lot of this corn is going to Mexico. In fact, the bulk of it here. And then so from soybeans, you're dealing with China, and you're also dealing with Mexico in here too. But you've got cotton, and we don't have a cotton price up here, but it's exhibiting some of the same characteristics that we see with some of these other commodities. But obviously a big bulk of cotton goes to Mexico, and of course it really kind of underscores the uncertainty right now. Here we have some labor numbers. We got the ADP number. This is not the non-farm number that you see that's the most highly publicized. This is a ADP private company, but it shows private non-farm payroll. You can see the dip here. You can see this is well below estimates, which were looking kind of like along in this range right here. You can see where the impact was. Transportation, utilities, education, and tech. We see here in information technology. Now, there were some offsets to that. Leisure hospitality continues to move higher, but we do have a decline in, anticipated travel. So it'd be interesting to see how sustainable this is. And then professional business service, financial, construction, and oddly enough, manufacturing, which has been rather weak as a overall sector for a couple of years, seeing that payroll growth at the small and medium-sized company level. Here we have some data from the Institute for Supply Management. This is the ISM Services PMI, which is Purchasing Managers Index. And so we've got a lot of PMI data from the service side. So the overall index, and again, we talk about data being soft and how it feeds into that GDP now negative growth estimate number. Well, this is certainly not one of those that's contributing to that, because the ISM services number is actually solidly positive, if not, robustly positive, which, something around 60 or above would be uniquely positive, but that's not the case here. So overall survey, definitely positive, reflective of growth. Anything over this line, the 50 line, represents expansion. Everything below it represents contraction. Really goes for these two charts here too. So new orders, again, they're in a kind of a trend line down, but they're still decidedly positive. So we don't have that issue there. And then on employment, we're seeing positive trends from the ISM services number here too. And then prices paid, finally, you can see that versus the estimate for the February data was a little bit higher than expected. You can see, perhaps a flat line for the most part here, and then beginning to tick up here as we head into the springtime of 2025. Now we've got some policy uncertainty data. This is out of Goldman Sachs research. You've got the trade policy uncertainty here. We've shown this to you for a couple of weeks now. Very, very telling, very telling. I mean, the uncertainty index is a level we've never seen it. There's just so much going on in Washington right now. It's hard to almost even keep track of it. And so here's the headline policy uncertainty index, as well as a trade policy uncertainty index. So, I mean, this is all economic uncertainty, at its peak right now. This chart, we have the potential impact from some of these things that we've been talking about on overall economic growth. So this is like tariffs in particular on year-over-year GDP or economic growth. And so you can see here from just a percentage points of overall growth that you have, at least from Goldman Sachs' point of view, that their baseline estimate is that you get into first quarter of 26 and you've kind of eroded about 0.7% of GDP because of these tariffs. Now that's their baseline scenario, and if you look at kind of a worst case scenario, then that looks something a little bit more like negative 1.25 percentage points. And so, again, if you're assuming that the economy is going to grow like on a nominal basis, maybe like 2%, 2.5%, then this is kind of this worst case scenario, if you will, takes you a lot closer to zero, at least for this particular period in time before it gets better. Here we have the estimates for recession probability. This is in red, we have the Bloomberg consensus. You can see that that's ticked up, as well as Goldman Sachs' own estimate. They're kind of in that 20-25% range. Again, it's not a high probability, not like it was here when we were fully expecting some type of recession. Well, we did get the rolling recession in manufacturing, but we just never saw it on the service sector. And again, this is a byproduct of uncertainty. It's a byproduct of some of the real-time data that we're seeing that's not particularly strong as it was, but at least the consensus is not expecting it, whereas you got BCA research that they feel, if the GDP down number from the Atlanta Fed is correct, and you get one more quarter of negative growth, then that's obviously going to push that probability up quite a bit. And I do think and I do put a lot of stock in the Atlanta Fed for their indicators, and I do think that that they do a good job of that, and they have lots of predictive power. That if that happens, you're going to begin to see these consensus numbers move higher from a recession probability standpoint. Here we have the New York Federal Reserve probability of recession in 12 months. This is looking out about a year ahead. And so, we were looking at much higher numbers, and those numbers have actually come down. We're, basically 23-24%. This is the New York Fed. So, you don't have a lot of consensus on this. So this is very interesting. So, what this is telling us is that while GDP now from Atlanta Fed is saying that we're going to have a negative GDP quarter, the consensus is telling us that it's not going to be sustainable and we're not going to get back-to-back quarters of negative growth. Now, that's not to say it's going to be really strong in the second quarter. It's just not suggesting that it's going to be negative. And so, for every put, there's a take. And so I guess my statement to you is that, the Atlanta Fed is predicting negative growth for the first quarter, but really no one out there has a real strong feeling that it's going to turn into a recession. Here we have some data on the inflation expectations and what this might do to influence the Fed on their monetary policy. So here we have basically 1 year ahead inflation expectations, and of course they were very, very low, kind of in the 3% range. That seems to have come up a little bit. So those estimates have now moved higher, as they have for longer term inflation expectations. And again, this is all a product of tariffs and what you might say about that. But again, we have a declining growth rate and money supply. And when you have that situation, when you have tariffs that increase the price of goods, just think of it this way: if there are 5 goods you buy each of them for $1, and you've got $5 to spend. Well, if one of them suddenly costs $2, well, you're going to buy that one good. You're going to suck up and pay the extra amount, but you're only going to have essentially $3 left for 4 goods that you would typically buy for $1. And so at some point you trade down or you substitute, and overall growth kind of stalls. And I think that's the most likely case scenario to the extent that these tariffs are sustainable. Now, the deal here is if you have inflation expectations, particularly here on the short term, if those are on the rise, it's going to make it very hard for the Fed to want to give those insurance cuts, with the prospect of having slower growth. And that's why we have lower overall longer term interest rates right now, is because there's a feeling that all of this stuff that's going on now is going to lead to slower overall growth in the quarters ahead. And so this slide is presupposing that maybe the Fed would step in preemptively and provide an insurance cut to try to forestall that. But if these inflation expectations continue to move higher, they remain sticky, the Fed's going to be a real tough spot. Here we have employment to population ratio. And so just this kind of speaks to participation rates. so on and so forth. This data from BCA research goes back to 1970. You can see how inherently cyclical it is. What's interesting here, again, not drawing a parallel or making a presupposition here, but in just about every case where you were going into a recession, that these numbers were rolling over, and very few cases here. You had kind of false positives, and where we sit here is the pandemic, and then we came out of it, and then you see the employment to population ratio go down. Now the labor market's been pretty strong, but participation has been very sluggish to come back. And again, just using the predictive power of these prior economic cycles, this alone would suggest maybe there's going to be some stress economically in the days and months ahead. But again, it's just data to keep track of, data to be aware of, and go into the spring with eyes wide open. Got a chart on China here. This shows basically, export volume growth, kind of going back into 2024, and you did have a lot of front loading. There was a lot of uncertainty about who was going to win the election. Obviously, Trump won in a rather relatively convincing way. And so what we have now, oddly enough, is a real stark divergence between export volume growth for China and import volume growth. And China has become, once again, one major export economy, and that's causing a lot of problems at home. It's causing a lot of problems in their economy, even though the stock market has done quite well. And current account, you can see here, big spike there. And this is a 4-quarter moving average. And so, even from China's perspective, I mean, they really need to drive more consumption, and that's been a problem. And just be interesting to see how these trends are exacerbated by tariffs to the extent they are sustainable. Here we have wholesalers' inventories. One of the things that we're looking for is perhaps a kind of a tail up in this. We haven't seen it yet. In fact, the inventories are actually going down. These are relative inventories. So there's wholesaler inventories divided by sales. So this is an inventory to sales ratio. And obviously you've had good sell-throughs. So when you have real strong sales that are ahead of their inventories, that number is going to go down. But on the other hand, if you expect tariffs are coming and you're trying to front load a lot of your orders to build up your inventories ahead of that, then you would see the inventory, basically the numerator, move much higher. And so you'd see this thing spike. But we haven't done it yet. So that tells me that we're not seeing a lot of anxiety and panic on the part of companies quite yet. Again, this data, is at a lag. So we're looking at essentially last month's data, or even in the worst case, we're still looking at January data. So even though we did get a modest tick up here, we start to get maybe a bit more worried if we see this thing kind of punch through 1.4 or even get 1.45 here. So we will definitely be watching that in the months to come. A high inventory number would help bolster GDP, because it is an investment in your inventory and your working capital, and that goes into the GDP calculation. But you don't want to see it all at once. You want to see a normalized economy where this data is trending and relatively stable within a band here. As promised, we talked about job cuts. We've got the Challenger Gray Christmas number. This is commonly just called the Challenger job cut number. Big spike here. Now, some of this represents federal employees that are being doged out, I guess, if you will. But you do see some increased announcements coming out of the private sector, and I'd say that this probably has more to do with what's going on in the private sector than anything else. And then we look at that same number over here. This is basically the announced layoffs, and then over here we've got initial jobless claims. And when you seasonally adjust these challenger numbers, you get to something that, there's a reasonable amount of correlation. I'd say it's not high, for mathematicians out there. I'd say this correlation probably looks to me like about a, yeah, point 0.6, 0.65. It's good, but it's not like super strong. But the what's being inferred here is that jobless claims number, which has been pretty sticky. In fact, if anything, might have been a little strong here in the last reading or two, is likely to move higher in the months ahead. Here we have car payments. You can see this is something that's also, very cyclical and very somewhat predictable patterns when you hit news cycles here. And this was of course, the pandemic. But now you see these delinquencies moving higher. And in fact, going back to 1994, we haven't seen a delinquency rate in autos at least since the early 90s. And that's pretty profound because we've been watching default rates, we've been watching credit risk and all of that, and we haven't seen a lot of the asset-backed credit really get hit. In fact, credit spreads are still really tight. It really just kind of belies the risk that there's actually any, or belies the notion that there's any risk to the economy out there. But this is the real data, and so you see that delinquencies and car payments are definitely moving higher. Here we're checking in on crude. We've got this really odd divergence here, and we've got several things at play. We've got Brent crude futures, which are going down. This is a feeling that, the economies are going to slow down here. And so, it's driving gasoline prices, driving crude prices down as defined by Brent crude. But gasoline prices are moving much higher. And so this is a tariff action. So again, you've got refineries in the U.S. that are really geared to refine the heavy crude coming out of Canada. And so if there's a downturn or cessation of shipments because of the trade war, this is driving gasoline prices higher. Even though our stocks, basically our inventory levels are actually pretty reasonable. Crude oil stocks are kind of at the lower end of their band. And then distillate stocks are really, really low. But, this number tells me it's driven by, fears, driven by anxiety. And what it could do is make that gas bill for your summer driving adventures a lot more expensive, certainly more expensive than they have been over the last couple of years. Here we have oil production. We talked about crude prices coming down. The feeling maybe is that we're going to have a slower economic growth rate, which would imply less demand for fuel, so on and so forth. But something that always catches my eye that is not often talked about. Russia. You think about OPEC plus and the OPEC aligned nations, which Russia has been one. Their production really peaked right about the time of the Ukrainian invasion, and it's continued to move lower since on balance, whereas the U.S. production rate in terms of millions of barrels a day, we're probably looking at like 12.3. Russia's at 9. Some of this gap has been made up for by OPEC, but OPEC's numbers are not robust either. I mean, the U.S. is driving innovation. They're driving the production gains around the world. Here we have some more trade data. This is economic risk for Canada and Mexico. Just say that this is, in the white here, this is like what we call domestic value added. So this is the amount of the overall economies within Canada, Mexico, and China that are exposed to U.S. imports. You can see here that, both of these are right around 15%. China, a little less impacted. We know that the China tariff back and forth from a trade balance standpoint, it's going to hurt them a lot more than it's going to hurt us. But strange things happen when you start tariffing, people. They start developing their own cottage domestic industries to provide more, competitiveness, and which in many respects is what, the Trump administration is trying to do here. But suffice it to say, there is a real impact on the part of Mexico, Canada, not so much in China, and these are the things that we're going to need to watch. So when you look at the impact of a trade spat or trade war, or, war is a big word. So I think right now we're still at the kind of a spat stage, and we'll see how, the rhetoric goes from here. But when you look at Canada and Mexico, I mean, you've got several areas that are fairly critical, and it goes without saying, those states that have closer proximity to either the northern or the southern neighbor are going to tend to have more net exposure to, as a percent of the value of trade. Got a chart here with productivity and labor costs, and productivity is something that we watch here. This is the non-farm business sector output per hour. So this is kind of the productivity of human capital investments, and you can see that traditionally it kind of like the line of best fit is around 2%, and the line of best fit for unit labor costs in the non-farm business sector is about 2%. You can see both of those are not trending awkwardly at the point. Again, this is data that goes back to 1960, so this is a lot of data here, and we did spike in productivity, just as we were coming out of that pandemic, and then it troughed, and now we see the ripple effects, and we're kind of like ending up in a place that's very close to the long-term average. That's actually a good sign. That's good for helping to potentially keep inflation low, or at least mitigate the increases in inflation that we might see otherwise. Here we have labor costs, which, as I said, basically, rents and wages are the stickiest piece of inflation. Really don't see a whole lot of, hyperinflation here. I mean, this is pretty much steady as she goes, multiple decades here. So just a couple of interesting data points for you there. So this slide from Apollo, we've got basically a downtick in vacation intentions. That happens when people worry about their discretionary spending and discretionary income. They start rationalizing things. So when they start curbing their trips, and you can see here that ever since the global financial crisis, notwithstanding the pandemic, you have this gradual uptick, which was really at a point that we haven't seen for the better part of 20 to 30 years almost, maybe not quite 30, but getting real close. But that certainly has trended down. Here we have capital spending. It's a very busy chart because you've got a lot of different Federal Reserve banks that are represented with their own surveys in their regions. But you can see in just about every case, they're all ticking down. And again, it's not a crisis point. It's not an area that that we're fretting right now. But directionally, you can see that they're all moving over, which is symptomatic of some slowing in the economic backdrop. And what that's doing is it's causing companies to kind of withhold capital investment for expansion, for retrofitting, and so on and so forth. They're just trying to maintain working capital. They're trying to maintain discretionary spending, and also, to the extent that they're, that they have standby reserves, or they got loans, or maybe credit lines, or they're just not using them as much now to prepare for the unknown. So when we talk about the employment numbers, I probably should have piggybacked this chart with the employment data, but you can see here that over the last couple of years, that a lot of the hiring that's been done, like in fact, like call it 23 to 28%, call it a quarter of all jobs added have been in the government sector. Now, this is not just federal, this is at all levels. But when you look at where government hiring has been over the years, and then you assume that 2023 was, quite a bit higher, well, that's saying a lot there. And in fact, it'd be very interesting to see how this proves out because, this is basically, essentially multiplying that by 4 or 300% more than it has been in aggregate percentage terms. And so government employees matter, even though there may be some that kind of discount what's going on with Doge. And honestly, we haven't seen a whole ton of the firings. We've heard a lot of announced layoffs and terminations, but we really haven't seen the follow through on that. It'd be very interesting to see how these statistics kind of manifest there. Something that really caught my eye here is that you basically in the blue in these different cohorts, so you have a big percent of the population that's not holding any kind of retirement assets. And I shared this with my team because it's just so profound that, basically you've got a rising Gen Z that they're not holding any retirement assets. And these are people that are up to 35 years of age. You got the 35 to 44, and you've got over a third of those people, over a third of the 45 to 54. And you used to have a large part of the population, particularly these baby boomers that are, retiring now. There's basically half of those that don't have any retirement assets, and they're depending on that monthly paycheck from Social Security or whatever. And maybe they, I didn't say that they wouldn't be included in this number if they had pensions, but they're finding other ways to get by, and this is actually a tragedy. It really speaks to the need for our profession to engage the older generations. You've got basically people that are much closer to representing the greatest generation. The bulk of them don't have retirement assets at the head of the household. So again, it's a call to action for us to do more education, do more outreach, and really kind of focus on both the young and the old, and not just the mainstream, the high earners that are in the peaks of their careers. Here we have some more data by generation, really. We've got gross income by generation. So this is the something that I wanted to focus on here too, because in this light area, this represents millennials. And so when you say like 2023, which is the last year of actual data, all of these are estimates over here, but like the actual data, you had about almost 40% of the gross income was generated by millennials. And these are the people that are going to inherit businesses. These are the people that are going to buy businesses and to attempt to grow them. And then when you're looking at 2025, you're going to see basically more Gen Zers come into the mix, and so that's, you've got millennials here. Gen Zers are going to exert their influence, and millennials will become, kind of static, if you will. And what you'll see really go down, what you'd expect are the Gen Xers, and then the rise in the aging generation. So that, those numbers will likely go up. So you'll have more of the young, you get squeezed in the middle, and then you'll have actually more of the old. And so this formulates, a large amount of thinking. So, we looked at that last slide, a lot of these generations just don't have retirement assets. Well, they're clearly not doing it because they don't have like income per se. It's just that we have to find a better way as an industry to educate them on the virtues of doing that. Here we have more data. I just love data. So this is data for those age cohorts that we've been talking through. Again, we've got the silent generation up here, and baby boomers moving down to the rising generation. So we've already talked a little bit about income, and this would be like earnings would be kind of a proxy for that. We know how that's changing. But oddly enough, net worth, we've got baby boomers really in the driver's seat here. And so you think about the baby boomers and their age and life expectancy and so on and so forth, that this is going to transition heavily over the next 15 years. You can see even in billionaire wealth. I mean, part of the critique here, and I know looking at the B of A's global research on this, part of their thesis is that, we would have a lot more billionaires if people would quit tinkering with their money and being so short-sighted with it. And, this is something that we preach a lot as well. But again, you've got baby boomers that are well represented in terms of holding the economic power of this country. But that is going to transition over time to the Gen X, millennials, and then eventually Gen Zers. Okay, we're going to drift into investment markets. Dollar, we know, has been soft. You can see that this number was ridiculously strong going back to September through the end of the year. The dollar just kept almost literally rising every single day. And, I think it's healthy because this, our trend line is probably, looking closer to that. And we've kind of broken through that. That's not to say that I want it to go to the floor, but basically that's what is, desired in all of this. The dollar weakens, and then because dollars are reserve currency and is basically the unit of measure in a lot of global transactions. If you have a weaker dollar, that's going to be better for commodities. It's going to be better generally for gold, which has done outstanding. And it's going to, when we say commodities, we're talking about like, oil prices as well, because a lot of those transactions are priced in dollars. Now we'll look at the S&P 500. We've obviously been watching with great joy, the long-term, relatively long-term rise. I mean, this is going back to September. Actually, the total chart goes back to the end of May of 23. And so you get really a chance to look at about 2 years worth of data. And again, it's kind of a boring line that moves relatively higher. Of course, 23, we had a bit of a market hiccup, and this is the S&P 500, and the same thing happened with the Nasdaq to a degree. But this would be like our 200-day moving average, and technically speaking, as long as you're trading above it, you're in pretty good health. If you break through, then then there are secondary lines of support, and we don't want to talk about that just yet. But we are trading above that 200 DBA right now. But again, we've taken a bit of a, basically of a downturn, not a full correction, unless you're talking about the Nasdaq, which did take which did hit negative 10% from the peak. Over here, we've got annualized consensus GDP estimates for the various indices. So we always talk about the S&P 500. At one point, the estimates were like 19%. And so when we talk about 2025, now you got a lot of people talking about basically half that. And I think that's a pretty good working number, which is close to 2023. And then 2025, expect to be a little bit more. That's still around 14, 15. And I think, these estimates may prove to be a little bit high, but it gets us in range, like I said. And you can see equal weight, you've got a continuous earnings rise, NASDAQ 100, you've got, basically, you've got EPS, earnings per share growth rates that are expected to moderate a little bit. But by and large, the earnings outlook is still relatively favorable. On this slide, we have the current activity in the major indices year to date. This is provided to us by Schwab and Lisanne Saunders. As you can see here that we have a lot of negative numbers here on the year-to-date return because we've had a lot of stress in the market. We've just been talking about that in the charts of the week with the fear of tariffs, growth slowing, trade wars, so on and so forth. So Dow Jones Industrials are flat for the year. And we have, the one thing I want to look at is the index maximum drawdown from year-to-date high. And so we've already seen in the NASDAQ and the Russell an official correction, if you will. So that's defined as kind of like anything off 10% from its peak. Now, we're not quite there on the S&P 500. Dow Jones, with its kind of an increased quality factor, and call it large cap, more value orientation, has been a bit more resilient. And we've seen a little bit of a reversal in trends here, that value's done a little bit better than growth has. S&P being much more of a technology index than it has been, but within these indices, this is what I wanted to end on here, is that the average member, the average constituent of the S&P 500 has witnessed a maximum drawdown of 13%. And what's even more astounding, in the NASDAQ index, the average member, the average constituent of the NASDAQ index has seen a 29% drawdown from its year-to-date high, and that's pretty profound. And that's why these indices are a lot more volatile. It's obviously a large reason why we've got some negative symbols in front of the year-to-date numbers. Here we have the always popular VIX. This is the measure of volatility within the equity markets. You can actually trade the VIX on the exchange. As you can see, it is exceptionally noisy, and it's really almost hard to draw a lot from this, other than we've had a lot more volatility in volatility over the last couple of years, if that makes sense, where the amplitude of these changes, are a lot more than they were, in the really the months and the quarters that followed the pandemic. So, all right, so we've got that. So volatility in volatility has picked up, but overall volatility has also picked up. And so when we look at call volume, this is an option that is leveraging a potential increase in volatility. So when you buy these call options, you're expecting volatility to go up, because you obviously want to take advantage of it, and that's exactly what's going on now. So here we've got the NASDAQ composite. We just showed you on the Lizanne Saunders / Schwab data that we've had basically a correction. You can see that down here. So NASDAQ composite drawdown over about 10.5%, and so I mean, we haven't seen that for quite a while, and you got to go back here to 2024. But obviously we had a lot of stress in the markets in 24 in pockets, and technology didn't do particularly well at that juncture, but obviously rallied since. So here we have the other chart, which is kind of getting back to the whole breadth story here, and we were having, we were witnessing some improvements there for a while, but this represents the percent of S&P 500 members that are above their 200-day moving average, and with all the sell-off, that's basically around half. So half the companies in the index are still trading above their long-term moving averages, and half the companies are not. Well, here we have kind of a testament to the power of diversification, and look at these portfolios long term. May kind of question, why do we have like international right now? I thought international was not doing too well. Well, but there's really strong value out there. And again, this is, trailing total returns in emerging market value. Again, that's not, particularly rewarding, nor is developed large cap value international. This would be ex-US. And, comparing that to US large caps, which have done quite well on a trailing basis. But as we've talked about with current multiples, I mean, we've actually talked a lot about this with current multiples. It would imply a lower overall growth rate moving ahead, and that's kind of exactly what's being built into a lot of these longer term forecasts. And so, but by the same token, these other areas of the world that have had some stress because of strong dollar, so on and so forth, they're expected to break out. And so when you look at these lighter blue bars here, I mean, that's pretty compelling when you look at the next decade of investing. And I think this really speaks to the power of diversification. All right, we've got a couple of public interest charts to conclude here. And so this one really caught my eye. This is data generation. And just think, I mean, we're right here. And, this represents, you think about like 130 on 150, and that's, what is that, about 20%? That's pretty amazing. We've had a 20% increase in data generation in 1 year, and that is expected to go parabolic. And so just think about the infrastructure investments that are going to be needed. Think about the power requirements that are going to be needed. Think about all of the the software and peripherals that are going to go with this data accumulation expansion. I mean, if we thought that we were dealing with big data here, I mean, just wait. I mean, over the next 5 years, it's going to be absolutely nuts. The last thing I'll show you is something that really piqued my interest, because you've heard a lot about, not only the failed meeting with Vladimir Zelensky, with Donald Trump and Vice President J.D. Vance, but then you've heard this side conversation about the interest and the desire to want to do a mineral rights deal with Ukraine as a way of helping to support, what we're doing militarily, etc. And this is a chart actually from Visual Capitalists that kind of does a real good job of telling us where all these things are. And so there was argument made, several Bloomberg and some other podcasts that were talking about how a bunch of these rare earths and other materials are in occupied territory. But you can see here that there's a lot of opportunity elsewhere if there is a truce, and this is where that line is drawn. Again, I'm not making any conjecture, but there still is a lot of opportunity here. Again, share global production, not significant, except for titanium, which is important for aircraft, etc. But anyway, I just thought this was interesting enough to share. That's all we have for this week. I hope you have a wonderful week. I will be on vacation next week, so you'll hear from me in a couple of weeks. So take care. Talk to you soon. Bye.